Hello, my name is Adam Beeler, Head of Institutional Sales at Angel Oak Capital Advisors. Angel Oak Capital Advisors is a leader in the structured and securitized credit space and has a competitive advantage due to our vertical integration with mortgage origination and processes assisting investors in the search for yield across all economic cycles. Our products are diversified across liquid and illiquid strategies, providing investors with optionality when it comes to finding the best fit for their liquidity needs. We are one of the largest originators of securitized non-qualified mortgages in the nation. We have a deep and seasoned team of professionals singularly focused and dedicated to serving fixed income and credit investors. And we offer one of the most comprehensive structured credit investment platforms in the market. Angel Oak continues to build upon the success of our insurance solutions platform. And today we'd like to have an informative discussion centered around insurance company reporting, specifically CECL, and how this is improving as well as affecting the need to accurately predict cash flows as well as losses. Insurance companies' demand for residential mortgage loans continues, as well as alternative structured products and funds, thus making CECL top of mind for many trying to improve their existing programs internally. Just for some key statistics, selfishly in the RML space, in 2023, total RMLs on life insurance company balance sheets were $82.6 billion. That's now grown in 2024 to $116.9 billion. So this trend, we believe, will continue. And again, making the accounting and the operational side of this process and onboarding this much, much, much more prevalent. Today's discussion is meant to be educational and hopefully thought-provoking. I'm pleased to welcome our guest, Theresa Meawad, Senior Director and Head of Solutions at SS&C. Theresa, thank you for joining me today. If you would, please introduce yourself and your background as well as your role at SS&C.
For having me. My name is Theresa Meawad. I'm the head of solutions consulting and thought leadership at SS&C EVOLV. And what that really means is that I get to talk to all of our clients and find out what their business needs are, especially as it relates to CECL reserving, stress testing, the credit part of the equation, as well as some loan accounting. I've been in this role for about 5 years. And over that time, I've expanded the number of clients and the types of clients that I've been talking to. Early on, it was primarily banks, and that's expanded into asset managers and insurance companies as well. Prior to joining SS&C, I was a director at Ernst & Young in their financial services group. So I was also consulting with the larger financial institutions around their needs for different reserving solutions and different stress testing solutions.
If you would, just give a little bit more about SS&C, the focus, the size, where you're headed, your exposure.
Yeah, so SS&C has been in business for almost 40 years now. Actually, we're coming up on the 40th anniversary next year in 2026. So it's founded in 1986, but it started really with a focus on insurance and asset management space to provide real investment accounting systems for institutions that were really missing access to relational databases and investment accounting support. Over time, has expanded to other institutions within financial institution space, so banking, some credit unions. We at Evolve focus mostly on loan accounting and then CECL across the asset classes, so bonds, reinsurance recoverables, loans, all of those things that fit under CECL. And we also do loan accounting and shadow servicing, but we have a lot of other partners within SS&C that focus on loan servicing, such as Precision LM, that focus on bond accounting, such as Singularity and Camera. SS&C is actually very large. It's one of the largest fintech firms in the country. Listed on NASDAQ under the ticker SS&C and has about 30,000 employees in 35 countries, which service 22,000 clients. So it's a very large institution. And it's grown through both organic growth as well as acquisitions over time. So Evolve was one of the acquisitions that SS&C made in 2015, and we've been happily part of that since.
To give you additional credit, we're here to talk about CECL, but obviously your company does a lot more on all aspects of insurance company reporting, modeling, regulatory reporting. But let's just dive into Evolve and specifically CECL. What is it? What does it do? Why is it helpful? And who uses it?
Evolve was founded in 2006 by a few founders who came from the financial restatement at Freddie Mac. So during that time, they saw a lot of accounting deficiencies in loan accounting that they couldn't find a solution that would meet their needs to bridge the gap between what servicing systems do and what financial reporting does. So all those gap adjustments like amortization, charge-offs, recoveries, all the things that happen to loans that the servicing systems don't handle appropriately, things like modifications. And so they came up with Evolve, the Evolve product, and That started out mostly in the amortization space, as we mentioned, and became an industry leader pretty quickly in PCI accounting for both securities and loans. And because of those two things, we became really, really good at forecasting cash flows, both contractual cash flows on the amortization side, but also expected cash flows for the PCI accounting side, and stripping down those cash flows between the interest payments and expected principal repayments. Because of that, over time, as GAAP changed and PCI accounting started to become less of a focus, and we moved into things like CECL, which is what we're talking about today, leveraging that cash flow generation engine was a good jumping off point to going to CECL. So CECL is obviously much larger than just cash flow generation, but that kind of led us in that direction. And because of PCI accounting, we were also good at taking things into account that would affect cash flows, like the future repayment speeds of some of these loans, what was happening in the market. So we didn't have a pure econometric model in place yet, but we had the build out for things like that. So when CECL came about in 2016 and was expected to be adopted in 2020, we worked on the piece that we were missing, which is having a true econometric model that created the reasonable and supportable forecast, because CECL requires you to account for the true macroeconomic model. So taking a step back, what is CECL? CECL is the new current expected credit loss model, which is the new GAAP requirement for loan accounting or for any financial assets that are not carried at fair value. Because there's an amortized cost component, they're not carried at fair value, there's a requirement to figure out what future losses are going to be and to record those future losses. This is a very big change from the historic perspective. Historically, we had the incurred loss model, which was looking at what already happened to your portfolio and reporting that. Right now, it's forward looking. So you look at the life of the instrument and figure out what all the future expected losses are going to be for each instrument. And depending on the asset type, that could be for RML, like you mentioned, that's like 30 years in the future, forecasting what your expected cash flows and losses are. But oftentimes, we can't really forecast what the economy is going to be over 30 years. So instead, we do the reasonable and supportable forecast period, which is what is actually predictable. Most clients that we've seen are between 18 months and 2 years, what they think they can actually forecast for the economy. As the economy has been volatile for the last few years and seems like it's going to continue to be volatile for the next couple of years, having that true econometric model that can predict what the impact is on your asset has become really, really important. And so we've really focused on that and built out a model that's robust, well documented, third party validated, and something that can stand up to auditor and regulator rigor at the same time.
And certainly, Angel Oak is focused on securitized products, securitized debt, residential mortgage loans, working with insurance companies on rated feeder structures. But this evolved product is helping not just with RMLs, right? This is helping with all asset classes and predicting losses or just predicting assumptions.
Exactly. So we currently have $1 trillion of loans in the portfolio, but we also look at things like HTM securities, which are also in the scope of CECL. Our reinsurance recoverables are a very big asset class from a lot of insurers. So we look at those. And then we also do things like AFS securities, which are technically not under the scope of CECL, but require similar models. So we're in that space as well. And SS&C EVOLV, because we've been in the financial reporting space for financial institutions for so long, since 2006, we have our SOC 1 and SOC 2, and we've maintained that since 2009. And we work with some of the largest institutions. So we have about $1 trillion in assets and $18 million of loans. And one thing that stands out about EVOLV among the other institutions and other vendors in the space is that we really think about CECL as an end-to-end process. So we don't think of it as just the model or just the cash flow generation. We think of it as all the way from data to disclosure. So what that means is we will validate a client's data. We'll ensure that it's coming in correctly, that the data makes sense because we've been in this space for so long and have a lot of business rules pre-built. We can figure out what different permutations of loan terms can take place or loan characteristics, and also on the bond side and the reinsurance recoverable side as well. So we'll be able to figure out if something is not making sense and report that back. We do all the calculations within EVOLV as well. We have our own models. If there's an asset class that's specific to an institution and pretty material, we also work with third-party vendor models that we can bring on the platform. And we will work with their own models. If they want to build one from scratch, we can customize models as well. We go all the way to the disclosure. So all CECL required disclosures are click button out of the box in EVOLV. And we have that business intelligence tool that sits on top that really allows for robust analytics as well.
And so that actually brings me to another point of you can walk in to an insurance company that perhaps has their own sort of homegrown Excel-based model. You can adapt that as almost like an input. You can share your product. There's multiple inputs inputs, right? So it's a collaborative effort of being able to say, what are you doing right now? How are you making model based assumptions? And how are you solving for these credit loss assumptions? Here's a different way to look at it. One of the things that's happening, right, is there seems to be a deeper demand for sophisticated product. You see a lot of private equity backed life insurance companies that have a swath of alternative investments and very creative strategies, and they continue to grow at significant rates. If you are perhaps a small to medium sized insurance company, you need to be taking a look at this stuff, but also to making sure that you do have the correct models, you do have the correct loss assumptions, and partnering with someone like yourself to help them solve that void.
Absolutely, and that's a very good point. It's not one size fits all. CECL is a very concept-based accounting standard, so there's no prescriptive model that's offered in CECL for all of your asset classes. There is a lot of management judgment that goes into it. So sometimes, even for clients that do have their own models and are looking to transition, it is really helpful to have that challenged by a third party or to have other options because ultimately it's management's judgment, but also management needs to be able to account for the fact that they did think through different models and came up with the right one for their asset class. And the model can be very different depending on what asset classes you're talking about. A model that's appropriate for RML is not appropriate for CMLs, and it's not appropriate for security. So thinking through that whole process is really important, especially as they continue to expand into new asset classes. You really need someone that has knowledge of what drivers of those asset classes are and can walk you through it as well to support the audit.
What do you think about any sort of regulatory concerns on the horizon? Maybe perhaps not using some of this technology to sort of protect yourself almost, not only from an investment decision, but from a regulatory oversight perspective.
We are part of several different groups that look at CECL. One is the CECL vendor group that's the AICPA put together. And so we're in touch with regulators consistently around CECL. And one thing that's really important is to understand that CECL is a new accounting standard. And because there's such a long-term focus of CECL, the 30-year life of the RML, for example, and because it's a new standard, there's the continuing post-implementation reviews and there's new tweaks to the standard that are happening as we go along. So for example, this December, the FASB announced that all purchase bonds and all purchase loans that are part of a business combination will now be treated differently than loans that were originated by a specific bank or a specific financial institution. So that change is very recent and something that Evolve has already been able to adopt. But things that we see coming down the pipe are originally the focus of the regulators was, is management picking a model that seems reasonable and is management documenting their decision? But that's actually evolved now. The model itself is becoming really, really important to the regulators, that management actually understands what the model is doing and that there's transparency, and then ensuring that they've thought through things like controls. Now that we're in this post implementation review and everyone's adopted CECL, that's something that is becoming important to regulators as well. So we definitely see a change in perspective from did you pick a model that management understands to now does the methodology make sense for your investment type? Can management explain why they specifically picked a certain model? One step further than that, are there model validation processes in place that are actually ongoing and able to appropriately validate the model? So is there back testing that's being done? Is there a challenger model in place? How often is the model being updated? Is management able to speak to the decisions that they're making as they go along? For example, for SS&C, we backtest our model every single quarter. We update our model every year to a year and a half, and we ensure that our model is third-party validated. We also have multiple challenger models within Evolve that a client can use to validate their assumptions. So that's becoming more the focus and moving away from the documentation perspective. But as I mentioned, there's also new accounting pronouncements that are changing. They're tweaking the pronouncement itself. There's also new disclosures that are being required. So, for example, modified loans now have to have enhanced disclosures. We're moving more towards transparency to investors and more towards transparency to auditors and regulators as well. And of course, as the models are being updated, there's more thought about what the materiality of that update was, why was it made, how did you decide that this is an appropriate new model to take on? So there's a lot more deep dives on methodology.
Well, that was going to be sort of my next question was what's the overarching theme when you're speaking to insurance company clients or prospects? Are they accepting this? Are they using this? Because obviously there's a cost associated with it, but there's also a cost associated with not doing something.
So I think everyone is doing something. I think the question is, what are they doing specifically to be ready for the future? Because I think what's happening when we see insurance companies getting into new products, there's a base model that's being built, like something in Excel, for example. And then what happens is as your portfolio grows and it outgrows those systems, or as it becomes more material and that loss estimate is getting more focus of regulators, are you then in a place to defend it? And I think that's where a lot of the changes are happening. So that perspective from let's just get this done, it's just a reporting exercise, to a more how do we get a sustainable process in place that is robust enough that it passes audit rigor, but also transparent enough that management understands it. Because what you don't want to do is get a model that has maybe a big name in modeling, but management doesn't understand it and can't speak to why it's appropriate for this portfolio. So there's that balance that I think people are starting to come to between the two. That's really the trend that we're seeing. But also, we're seeing there's a different focus on investment in new asset classes. And so, people in that situation, we are seeing there's a need for guidance as well as a need for the software. So, that consultative implementation process is more important than ever. But how do you know that the model is the right one for your portfolio? Can your vendor actually talk you through that and explain how they came up with their model? Historically, there's a lot of dependency on the vendor said so. But now, as the regulators are asking deeper questions and auditors are asking deeper questions, that doesn't fly. And so there's a lot more focus on transparency. One other thing that we're seeing as a trend on the CML space, just to pivot a little bit, the one big difference that we're seeing between CMLs and RMLs, for example, RML and the loans themselves, the structure is pretty similar depending on which bank you go to. On the CML space, there's a lot more structuring. And there's a lot more large landlords that own multiple properties. And so they end up falling under serious regulations in different jurisdictions. So, for example, New York is a big one today that's getting a lot of focus because what's happening is as landlords expand their tenancy, they're getting more into rent control spaces where now they have to be regulated by those rent control standards. And so the geography makes sense. The structure of the loan is important. And there's a lot of push for landlords that own a lot of square footage, for example, to invest in climate neutral or climate enhancing types of air conditioning units and heating units. So there's a lot more emissions focus in those spaces that can affect the landlord's cash flow. So understanding that for each of your locations is very, very important. It's important in the residential space as well, but especially in the CML space because of those larger square footages is becoming a trend that people really want to deep dive on each individual property. But there's definitely a balance here because CECL specifically says this is a collective allowance. So there is reaching that middle ground that a vendor who is informed in the space can help you reach between looking at each property, which you're actually not allowed to do, to a allowance that's just so high level that doesn't take into account any of the complexities in each jurisdiction. So that balance is important to reach.
And it's a lot. Obviously, it's an enormous amount of data. It's an enormous amount of data inputs. I mean, we know that obviously from the mortgage origination side of coming up and making, an educated decision on is this a good credit or not. And obviously our
Sure.
firms have a history of being able to do that and executing that. So what, in your opinion, where is the proverbial puck going next? Increase regulatory oversight, decrease regulatory oversight, new changes to the NAIC, specifically as it pertains to reporting? I can't imagine that it's going to get less. Obviously, transparency and liquidity are the most important things to investors, and we all should be striving for that. So, what is next?
What I think is going to be what's next from a regulatory standpoint, CECL naturally, the way that it was written, has two types of disclosures that are required within it. The first is quantitative disclosures, which is what everyone does typically, which is like amortized cost by vintage. You create a table in your 10K or Q or your investor reporting, and then that's done. But CECL specifically requires a second set of disclosures, which is qualitative. So management explaining what happened to their allowance and why it's appropriate. That part, I think, is gonna get a lot more rigor, going forward, and there's gonna be a lot more focus on making sure that the information is actually enough. Like, is it robust enough? Is it meaningful enough? Does it give investors what they need? There's gonna be a lot more focus in that space, especially for loans and bonds that are not liquid and they're not as easily quantified by the investors themselves. So the investors require more of that. And that's actually why when we built out our CECL solution, we really built out our analytics framework to be a true business intelligence tool that's so flexible and the calculations to be done at the lowest level possible so that regardless of what management wants to report or what's required, that's available to do using our business intelligence tools. But I think that focus is going to grow. And I also think from another standpoint, the focus on data is going to grow as well. There's a lot of focus as you talk to people in the industry about not having enough data to do the disclosures and to make them meaningful. And I think that's going to become a bigger source of friction going forward, but also it's going to become a bigger source of review from the regulators.
I would agree with you completely. Theresa, perhaps we could spend just a little bit more time on homegrown models versus canned models versus a combination versus outside inputs. Maybe you could go a little bit deeper there.
So, one thing that I wish people did more as they were making this decision is really think about the whole investment. What are you investing in versus the return in this space? I think a lot of times when we're talking to clients and they're picking a model, there's a lot of focus on that upfront investment and not as much thought over the long term. So, for example, as I mentioned earlier, the model is very important, CECL. It's definitely not the only important part. CECL is still an accounting standard. And so that whole process really matters. Making sure that you're covering everything from the data to the disclosures, all the calculations, all the data smoothing that's going to have to be done, all the identification of data errors. A lot of times the data is not complete, or you'll have to fix the data as there's late reporting coming in. So all that stuff has to be accounted for as well. And then just from an investment standpoint, are you thinking through this actual software investment as well as the model itself, that investment, the generation of the cash flows and the economic forecasts, having to get those from different sources, doing the cash flow forecasting, and then, of course, implementing the SOX controls. But something else to think about is not just what it's costing today, but thinking forward a year. Are you able to validate that model when it's in production? Is that being validated by someone, or is that going to be on you to validate? As you're getting new types of instruments, are you able to think through every possible permutation of loan terms and what makes sense and what doesn't? The system should be able to identify errors for you so that it's not you're reporting a number and having to restate it later potentially. Do you have the right model for each asset class, which we talked about at length earlier? But that's a really important part of CECL as well. And then, of course, the documentation of the models themselves. So all of that is really part of the upfront model investment. Talking a little bit more about validation, though, the more custom the model is and the more management input is in that model on an ongoing basis, the more you have to validate it and the more it's going to require back testing and recalibration. So, as that model is being recalibrated and validated each year, you're probably bringing in additional consultants from outside that are validating that model, and that can be really expensive. All of that should be thought about. It's really important when you're thinking about a homegrown model because those are very custom, but it's also very important when you're thinking about a vendor model. Some vendor models just provide the software and management has to make all the decisions about the different variables that they're going to use for each asset class and really writing the equation themselves, but just using the software. But that's going to be very costly from a model validation perspective. So make sure that's part of the thought process. And then also think about how seamless the process is. Some vendors are much more integrated, like Evolve, where the data comes in and then you're running all of your different models in one space and it's creating a report for you that combines all of that. If you're home growing a model, it can usually look like this, where the model is forecasting a PD and LGD loss rate, which is then applied to cash flows in a different place, which is then combined into an allowance number in a different place. And then you have to combine all of your asset classes in at the last place to do your disclosures from. So those are really important considerations to make as you're selecting between a vendor model versus homegrown, but even as you're looking at different vendors, you have some questions to think through as you're picking through those things.
That's a great point. Theresa, thank you again. I really appreciate your time, your thoughts, and I look forward to doing another one of these next quarter. If anyone listening to the podcast has any questions, Theresa, where can they send you an email or get more information from you?
So you guys can contact me directly at trese.meawad@sscinc.com. Or if you go to ssctech.com/evolve, you should be able to contact me through there as well. And you'll also be able to access all the thought leadership pieces that we've done.
That's great. Thank you. And if anybody has any questions or wants to learn more about Angel Oak and our insurance solutions group, you can email us at info@angeloakcapital.com. Theresa, thank you again for your time and look forward to the next one. Take care, all.
The views expressed represent the opinion of Angel Oak Capital Advisors, which are subject to change and are not intended as a forecast or guarantee of future results. Stated information is derived from proprietary and non-proprietary sources which have not been independently verified for accuracy or completeness. While Angel Oak Capital Advisors believes the information to be accurate and reliable, we do not claim or have responsibility for its completeness, accuracy, or reliability. Statements of future expectations, estimates, projections, and other forward-looking statements are based on available information and management's view as of the time of these statements. Accordingly, such statements are inherently speculative as they are based on assumptions which may involve known and unknown risks and uncertainties. Actual results, performance, or events may differ materially from those expressed or implied in such statements. All investing involves risk, including the loss of principal. There is no guarantee that investment objectives will be attained. Results may vary. There is no guarantee that risk can be managed successfully. This document does not constitute advice or a recommendation or offer to sell or a solicitation to deal in any security or financial product. It is provided for informational purposes only and on the understanding that the recipient has sufficient knowledge and experience to be able to understand and make their own evaluation of the proposals and services described herein, any risks associated therewith, and any related legal, tax, accounting, or other material considerations. To the extent that the reader has any questions regarding the applicability of any specific issue discussed above to their specific portfolio or situation, prospective investors are encouraged to contact Angel Oak Capital Advisors or consult with a professional advisor of their choosing. There is no guarantee that the investment objectives will be achieved. Moreover, the past performance is not a guarantee or indicator of future results.